Joining me, David Neuhauser, CIO at Livermore Partners. Good to have you back, David. It's been too long. Thanks for being here with us this afternoon. How are you?
No worries. How's everything? I hope everything's well.
Appreciate that. Well, we're melting up in the stock market, so days where Bitcoin's down 1%, Nvidia's only up 1%. It's like the most interesting thing to talk about. Am I losing my mind?
Yeah, it's an interesting day. I mean, yesterday, obviously, you had the announcement, obviously, from the Fed in terms of it looks like they're going to do with their path, which will be to lower rates in the coming several months. I think the market was obviously anticipating that, but they wanted to make sure that the Fed was still on side with that. So, I think they took that as a validation, and the market ran a bit yesterday to new highs. Today, I think we've reached a new peak. But like you said, certain risk assets have actually come off. So I think some of that is that people are looking at some of the other central banks around the world, like Swiss National Bank, like the UK, Bank of England, where it looks like they may be getting ahead of the Fed in terms of cutting. And therefore, the dollar was actually a bit stronger today. So I think that ended up taking a bit of the wind out of the sails from the market.
Okay, and I like that you bring that up because I was thinking about that too. Pretty strong bounce in the dollar, given how dovish Jerome Powell sounded yesterday. Tell me what the FOMC meant to you as someone who's been in the gold trade for a while and have been correct as this thing is broken out. Is that still kind of your main macro rate-driven trade, David? Gold?
Yeah, so it is, Oliver. It's been that way for actually a few years now. It continues, and I think structurally it just makes so much sense. I mean, on one hand, you have a Fed that has increased interest rates several times over the past number of years. Inflation, of course, has risen dramatically. Inflation has come off its peak, of course, but at the same time, a lot of that is due to deficit spending. Fiscal deficits are getting out of control, as you know. The CHIPS Act and other things are helping add more to the market and to the economy in terms of stimulus, and that's what's, of course, leading the charge. So with that, I think gold is obviously broken out. It reached an all-time high last night. It's come off today again based on what I described with the other central banks getting ahead of the Fed. But again, this goes back to what you described, why are risk assets not exploding today? And I think a lot of that is there's really a tough call here. Where is the Fed on side or not, or is the Fed making a policy mistake? And time will tell. But here on one hand you have a Fed that's saying that inflation's coming down, but we know from just the recent history in the past few reports it's actually increased again and reaccelerated. And at the same time they're looking to become even more accommodative to the market. So if that is actually true, you would expect some of those risk assets, things like gold, Bitcoin, and other things that just completely explode, and thus, the commodity trade would be alive and well. But it doesn't seem like it's having that force today.
Not on the commodity side just yet, but it's improving here the last couple of weeks for sure. We're starting to see some of the commodities bottom out. How do you navigate the gold trade then? Is there some reflexivity to it to where you have to be careful, where if the Fed is too dovish, we get surprisingly strong growth, and then we do this kind of repeat on yields again? Because we're already kind of doing it with commodities. Commodities bottoming out. If rates start to come back up too, does that threaten gold? How do you maneuver those kind of swings in the cycle as the Fed kind of tries to sharpen around the edges possibly?
Yeah, so that's a great question. I think a lot of that's unknown, because if the Fed ends up doing a 180, actually doesn't cut 3 times this year, if they end up cutting 1 time, or if they don't cut at all, obviously yields will rise.
Okay.
Yields rise, of course, bad for gold. But at the same time, you got to remember, if yields rise, more than likely that tells you inflation's even hotter. So that means gold trade would actually do even better. And at the same time, any strong increase in yields for even longer seems like it's actually having it's slowing down the economy to some extent, especially at the lower end. It's not affecting the high end, the ultra wealthy. I think that's mainly because their AGI, their adjusted gross income, since 2021 has kind of exploded, where it's higher than 20%. So that's feeding into the to the travel sector, areas of healthcare, areas of the in terms of the market, because asset prices are much higher. So they're feeling that wealth effect and they're spending. On the very lower end, that's where it's still a challenge. The benefit there is, of course, wages are increasing, and of course, unemployment is still relatively very low historically. So something still has to give here in the next several months. And I think the market is still trying to come to grips as, is the Fed correct, or is there an imminent policy mistake occurring in the next several months?
I think that's a really interesting point when it comes to the wealth effect impact that I still feel the Fed and many others understate, especially when we see how rabid speculative trading is in so many categories right now that people are able to generate wealth. I mean, that's kind of, if you ask any coiner, or like, it's kind of their argument. They're like, well, this is my chance to get rich, so I'm going to go try and time dog with hat. It might be beyond my risk spectrum or many other people's, but it brings up this idea of what happens when the music stops and if the stock market itself becomes a threat to the economy. Is there any bigger economic threat than NVIDIA dropping 20%, David?
Yes. I mean, I think NVIDIA and even the S&P index, I mean, look, even if it falls back 10%, even 20% from these levels, I think it would be a shock. You would see an impact in the economy, especially, again, at the higher end, the people that own the assets. But ultimately, that's not a big enough standard deviation move at this point in time that would, I think, really change some of the structures that are in place.
Okay.
So to me, it seems like you need more. You're going to need to see economic contraction. But again, to date, we haven't seen that. To date, we have GDP running hotter. We have inflation reaccelerating. So again, I said this before several months ago, like it seems that someone has it wrong. Either the Fed is going to let inflation run, which if that happens, you do want to be in commodities. Those are the you want to be: gold, oil, obviously even on the front end of the curve. That's where you're going to make money. Very specific asset classes or sectors of equities, of course, are doing well, as we know, AI and cloud. But there's a lot of other areas that are still not. So it's going to be really impactful to see, where the market moves here in the next several months. It's sort of like 5,200 or so on the S&P up, or can we see a reacceleration to get to new highs in the coming months? That'll be the ultimate question.
All right. And it sounds like right now you'd rather stick with the guns in the gold trade, the commodity trade, and as you kind of called it there, the rich boomer trade in a way. David, we got to jump because we're kind of losing your audio as much as I want to talk more. Appreciate your time. David Neuhauser, CIO at Livermore Partners, with the macro setup here for our afternoon.